Welcome back to the Deep Dive. We often try to understand history as a sequence of grand laws and inevitable trends. But here, we look for the seconds that changed everything.
Today, we are using the analogy of a dam. The water rising behind it represents, decades of slow, crushing economic tension and anxiety.
And our deep dive today is about the crack in the concrete that almost burst that dam entirely.
We're talking about the 1980 attempt by two Texas oil billionaires, the Hunt brothers, to corner the world's silver supply.
A crisis that didn't end with some dramatic battle on the trading floor. It actually hinged on one single, secret, closed-door regulatory vote.
Yeah, a vote that acted as the fulcrum point, really, determining whether the global economy sank or stayed afloat.
So our mission is to explore that whole pressure cooker situation. We'll start with the pressure, right? The incredible wealth and the philosophy that drove the Hunt's strategy.
Then we'll zoom in on the fulcrum moment itself, that single regulatory move that stopped them. A vote that was, and this is key, a near miss for global finance.
And finally, we'll track the flood of consequences, the day known forever as Silver Thursday.
It's a story that really reveals just how fragile the architecture of modern finance is.
It really is. Okay, let's unpack this.
Let's get into it.
To really get your head around the sheer audacity of the Hunt brothers' plan, to physically hoard enough silver to hold the world market hostage, we have to start with the economic climate.
We have to. The 1970s, this was the rising water behind our metaphorical dam.
So what was driving all this anxiety? What was in the water, so to speak?
It was a decade of financial vertigo. I mean, the post-war era of economic certainty just evaporated.
Right.
You had relentless soaring inflation that was just chipping away at the value of the dollar every single day.
And on top of that, the OPEC oil shocks, which created this huge energy crisis.
Exactly. Another layer of instability. People just generally felt that the whole system was fundamentally shaking itself apart.
And the root of that instability, maybe the real catalyst for distrusting paper money, was a decision made almost a decade earlier, August 1971.
Yes. When President Richard Nixon officially severed the U.S. dollar's last tie to gold.
The Nixon shock.
The Nixon shock.
Yeah.
Before August 15, 1971, a dollar was, at least in theory, a claim check. You could exchange it for a specific amount of gold held by the government.
But that decision transformed the U.S. dollar into what we call a fiat currency.
Correct. A currency backed only by the faith and credit of the government that prints it. Nothing tangible.
And when you've got runaway inflation and energy crises, that faith starts to look pretty shaky.
Precisely. For a lot of traditional investors, especially people whose wealth was built on tangible things, like oil and land.
The dollar suddenly felt flimsy, unreliable.
Exactly. And financial historians, they pretty much all agree that this anxiety about currency debasement and inflation was the fundamental driver for this massive capital flight toward hard assets.
And nowhere was that distrust more ingrained than in the family that drove this entire crisis. The Texas oil dynasty founded by the legendary H.L. Hunt.
Right. Nelson Bunker Hunt and William Herbert Hunt, and their brother Lamar, too. They were raised in this philosophy of profound skepticism about government, about paper money.
Their father, H.L. Hunt, was a man who believed you should only trust what you could literally touch.
Oil from the earth, land, cattle. In their world, paper money was for what they dismissively called papermen.
Meaning politicians and bankers.
Yeah, people they saw as actively undermining the nation's wealth through reckless inflation.
So for them, it wasn't just speculation, it was ideological. They were looking for a fortress.
That is the perfect word for it. They needed a tangible, globally recognized asset that could serve as an absolute hedge against the collapse of fiat currency, a collapse they believed was inevitable.
They weren't just looking for profit, they were looking for financial survival for their massive dynasty.
That's it.
So why silver then? I mean, gold has always been the classic choice for that kind of fortress.
Gold was the classic choice, you're right, but it was heavily regulated, especially after decades of government control over gold reserves.
Wow.
Silver, though, it offered this unique combination. It was still seen historically as a monetary metal, so it had that psychological weight of money.
But it was also a crucial industrial commodity.
Right, used in photography, electronics, manufacturing, and crucially, in the late 1970s, it was far less regulated than gold.
Which made it available for accumulation on a scale that almost no one could even imagine attempting.
So you have this profound fear of paper money, combined with the ideal properties of silver, and that just sets them on this collision course with the very financial system they were trying to shield themselves from.
They weren't just making a large investment, they were trying to stage a revolution in wealth preservation.
Yeah, by draining the world of a fundamental commodity. In essence, they were trying to privatize a significant chunk of the global money supply.
Okay, let's turn to the mechanics of the squeeze itself. Because they didn't just buy silver, they executed this brilliant, if destructive, financial maneuver to corner the market. How did they do it?
Well, the foundation of their strategy was the futures contract. You can think of it simply as a contract to buy silver, say 6 months from now, at a price you agree on today.
Which is standard practice on exchanges like COMEX.
Totally standard. But the Hunts elevated this from standard trading to an act of systemic pressure. The critical ingredient was leverage,
Right. Borrowed money.
an absolutely staggering amount of borrowed money. That's what turned them from major speculators into market wreckers.
So when you trade on margin or with leverage, you only put down a small percentage of the contract's total value, right? Maybe 5%.
And you borrow the rest. The Hunts operated with extreme leverage. We're talking about a situation where for every dollar they truly owned, they were controlling $30 or maybe even $40 worth of metal through these futures contracts.
Wow. So their exposure was immense, but their ability to move the market was exponentially amplified.
Precisely. But here's the critical twist. The thing that created the physical crisis. Most speculators who buy futures contracts, the vast, vast majority, they never intend to take delivery as the actual commodity.
They just settle for cash before the expiration date.
Exactly. The Hunts, however, demanded physical delivery.
Ah. So they weren't just betting on the price, they were physically emptying the warehouse.
That is the perfect analogy. Crate after crate, ton after ton of silver bars were taken out of the exchange vaults from New York's COMEX, Chicago's CBOT, and moved into private storage.
And not just any storage.
No. Often flown via chartered jets to these impenetrable Swiss vaults, they were actively removing the underlying asset from the marketplace.
I can just imagine the growing panic among the exchange staff as they watch their physical reserves just dwindle.
It had to be terrifying.
Yeah.
I mean, the commodity exchanges are designed to handle paper promises, the vast majority of which, as you said, are cash settled.
But when the Hunts demanded physical delivery, the exchanges suddenly faced this profound existential reality.
They were running out of actual tangible silver to deliver to anyone else who had bought futures contracts. That's the squeeze in action.
So let's put the scale of this into perspective. What are the numbers that really define the audacity of this corner?
By the peak of their accumulation, the Hunts' physical holdings, combined with their massive futures contracts, it was estimated at over 100 million troy ounces.
100 million.
And to give you some context for that number, it meant they controlled roughly 1/3 of all privately held silver on the entire planet.
That's not just a large position. That is market domination by a single family.
It's unbelievable. And the market, of course, reacted violently to this unprecedented depletion.
I bet.
Viciously.
Yeah.
The price of silver, which was hovering around $6 an ounce in early 1979, began this relentless parabolic ascent.
It just went straight up.
It climbed, it surged, and then it exploded to a record intraday high of nearly $50 an ounce in January 1980. And that price explosion created systemic risk. It threatened the integrity of every commodity exchange, every brokerage firm, because the exchanges simply couldn't fulfill their contractual obligations to deliver physical metal at those soaring prices.
The water had reached the very top of the dam.
And the regulators knew a failure was imminent.
The pressure has peaked. We're now moving to the critical juncture, the crack in the concrete, the single decision that determined the future of the global financial system.
Yes. By January 1980, the crisis was immediate.
Where were the decision makers and what was the atmosphere like?
The location was a private, unpublicized room at the New York Commodity Exchange, COMEX. The atmosphere, I mean, you have to imagine it was just electric, thick with fear and desperation.
Because the exchange was facing an existential threat.
Absolutely.
Yeah.
If they ran out of physical silver and defaulted on their contracts, it would trigger a chain of failures across Wall Street, a global domino effect that could make the 1929 crisis look like a dry run.
So they were meeting with one explosive purpose.
To decide whether to break the rules of the game mid-play to stop the Hunts.
That's huge. This wasn't routine oversight. This was a crisis of conscience for the COMEX Board of Governors.
It was. The exchange operates on this principle of sacred trust, that the rules, however complex, remain constant throughout the game.
And changing the rules after the fact was deeply controversial. It violates what many saw as the fundamental integrity of the free market.
You had powerful people in that room, who were hardline free market purists.
So what was their argument against intervention?
Their argument was philosophical, but also deeply practical. They contended that if the exchange intervenes, it risks destroying its own credibility forever.
Right. If you start changing the rules because a rich player is winning, who will ever trust the market again?
Exactly. They argued that the Hunts had used the existing open rules leverage physical delivery demands to execute their strategy. And any failure, though catastrophic, should be absorbed by the market. A necessary, painful lesson in risk management.
But that argument was running up against a terrifying reality. The Hunts were winning the game, and if they continued, they guaranteed a catastrophic default for the entire institution.
And all of its related brokerages. They were caught between the rock of market purity and the hard place of global financial collapse.
They were staring into the abyss.
The debate was furious. It went on for hours, maybe even days. The weight of potential global catastrophe was resting squarely on their shoulders, forcing them to choose between precedent and preservation.
So after this incredibly intense debate, they chose preservation.
They did.
Let's zero in on the specific date and the technical name for this fulcrum moment. What happened on January 7, 1980?
On that date, by a majority vote, the COMEX Board of Governors voted to enact Special Silver Rule 7.
And this rule was the decisive surgical intervention designed specifically to stop the Hunt strategy cold.
That's exactly what it was, a technical dagger.
Yeah. So let's break down the language of Rule 7, because it sounds bureaucratic, but its effect was just devastating and immediate. It mandated liquidation-only trading. What does that phrase actually mean for someone holding billions in leveraged silver futures?
It means they simultaneously lock the door and open the emergency exit.
Okay.
Going forward, no one, not the Hunts, not anyone else, could open a new long position in silver futures. No one could place a new bet that the price would go up.
The only transaction available was to liquidate existing contracts.
Meaning the only allowable move was to sell.
Wow. Can you just walk us through the trap that the Eggs created? If the Hunts needed constant buying pressure, fueled by new money and new leveraged bets, to sustain that incredibly high price,
Right.
what did this rule do to their position?
It was a death sentence delivered by semantics. A leveraged position is fundamentally dependent on momentum. As long as the price is rising, the value of your collateral, the silver, covers the loan.
But the minute you ban new buyers,
The demand side of the market just evaporates instantly. And the supply side, all the people who were long and were now getting very worried about the price, they're forced to liquidate.
so Rule 7 didn't just stop new money from coming in. It systematically turned every potential buyer into a forced potential seller.
Exactly. The board didn't technically force the Hunts to sell, but they engineered a market condition where selling became the only viable, or eventually the only mandatory, action.
They just removed the scaffolding that was holding up that $50 price tower.
And the Hunts' vast leveraged position, which relied on the expectation of endless upward momentum, it was suddenly rendered completely unsustainable,
The clock was ticking.
down to the moment they would fail to meet their margin requirements. And this action was quickly coordinated, right? This wasn't just COMEX acting alone.
No, and this shows the quiet involvement of the government. 2 weeks later, the Chicago Board of Trade, the CBOT, followed suit.
On January 21st, 1980,
They imposed similar restrictions, and this joint regulatory front sealed the fate of the silver corner. It ensured there was no major exchange left where the Hunts could continue to accumulate or fund their position.
what I find most extraordinary, and this comes from sources detailing the board meetings, is that this wasn't some unanimous, easy decision. The sources really stressed that the final vote was far from a slam dunk.
That is the most chilling detail, isn't it? It's the core of our fragility thesis.
It is. This multi-billion-dollar global event, which secured the stability of Wall Street, it didn't hinge on some pre-programmed mechanism or a law passed by Congress.
No, it hinged on a handful of men representatives of commodity firms, banks, the exchanges voting in a private room.
And we know, based on internal board meeting minutes, that the powerful voices arguing for non-intervention almost prevailed.
They almost chose philosophical purity over systemic safety.
They did. And you have to appreciate their position, in a way. Setting a precedent that the exchange will just bail itself out by changing the rules when the stakes get too high, that's fundamentally dangerous for the free market's reputation.
But the alternative was just unthinkable?
It was.
And this is where we have to confront the catastrophic counterfactual. What if? What if those hardline purists had won?
What if just one or two governors, swayed by fear of setting a dangerous precedent, or even by the sheer power of the Hunt family, what if they'd changed their vote or abstained?
And Silver Rule 7 had failed.
If the rule had failed, the Hunts would have maintained their momentum. The price would have rocketed past $50, maybe towards $100 an ounce.
Because the demand for physical silver was still immediate and no one could stop the accumulation.
Exactly. The immediate horror would have fallen on the major brokerage firms who had loaned the Hunts billions to finance their hoard.
You're talking about firms like Bash Group and Merrill Lynch?
Right. As the price climbed, the exchange would have demanded increasing amounts of collateral cash from these brokers to cover the Hunts' ballooning loans.
And the brokers just wouldn't have had enough liquid assets.
They would have defaulted first, almost instantly.
And the failure of a massive brokerage like Bash Group becomes immediate systemic contagion. This is where Paul Volcker, the Fed chairman, enters the picture, just terrified.
Absolutely. Bash Group was deeply interconnected with every major commercial bank on Wall Street through interbank lending, all sorts of financial instruments.
Its failure would have triggered cross-defaults across the entire American banking sector.
And analysts feared this event would have caused a global financial crisis. Bank failures that would dwarf anything seen in the Great Depression.
So the history we inhabit, the stability of the global financial system as we know it, was determined by the narrowest of margins. A handful of votes in a small, unpublicized room on January 7, 1980.
The system was saved by the capacity of a few stressed, fallible human beings to abandon precedent and intervene decisively. It's the ultimate revelation of financial fragility.
Rule 7 was the trigger, but the mechanism of the Hunt's destruction was the margin call. The dam had been cracked, and now the flood begins.
Right. And even after the vote, the price of silver actually kept rising for a bit, didn't it?
It did. There was this period of market lag. Silver actually hit its record intraday high of $49.45 per ounce on January 18, 1980.
But that was, as historians describe it, a dead man's twitch,
A great phrase.
isn't it? The necessary foundation, that constant buying pressure required to sustain a leveraged corner, it had been seismically removed by Silver Rule 7.
The market finally realized it had no upward momentum, and the price slide began.
And as the price began its inevitable slide, the avalanche started, and the margin call mechanism kicked in.
Which became the death warrant for the Hunt's empire.
Absolutely. Their fortune was tied up in leverage. They had borrowed billions, using their silver holdings as collateral. So imagine you take out a massive loan to buy a house, and the bank needs you to keep the house's value above the loan amount.
As the silver price fell, say from 49 down to 30, the value of their collateral just evaporated.
Almost instantly. And the lenders, the brokerage firms, they realized they were underwater. Their primary broker, the Bash Group, recognized the profound risk and needed to secure its loan immediately. They issued a demand for the Hunts to deposit a massive amount of cash to cover the shortfall.
And that demand, the margin call, it quickly swelled into a debt of over $1 billion.
$1 billion in 1980. It's an almost incomprehensible amount of money for a single individual to produce in cash.
It was devastating. The margin call was the direct legal consequence of the price drop engineered by Silver Rule 7.
And the Hunts, who believed they were operating in this fortress of tangible assets, suddenly needed paper cash, the very thing they distrusted.
In an amount they simply could not produce quickly.
So for 2 agonizing months, the Hunts scrambled. They tried to sell off other assets, oil properties, desperately trying to raise the cash to meet these looming obligations.
But they were fighting a losing battle.
Of course. The market knew they were distressed sellers, and that only made the price decline worse. Every time they sold assets, the price of silver dropped further, triggering even larger margin calls.
And by late March, their time had completely run out.
Which leads us to the climax. The failure to meet that enormous, unrelenting margin call led to the catastrophe. March 27, 1980.
A day burned into financial history as Silver Thursday.
This was the moment the floodwaters burst through the broken dam.
So what defines that day? What happened on the trading floor?
Pure, indiscriminate panic. The Hunts, unable to meet their demands, were forced to begin liquidating massive amounts of silver onto a market that was already saturated because of the liquidation-only rule.
This wave of forced selling, with virtually no buyers allowed to enter the market.
It meant the bottom just fell out. The price plummeted by 50% in a matter of hours.
50%.
Yeah, it fell from over $20 to below $11.
And the crisis was no longer about the Hunts' personal greed. Now it was about the systemic risk created by their failure to pay Bash Group that billion-dollar loan.
That is the critical distinction. Systemic risk realized. The failure of a massive interconnected firm like Bash would have caused its creditors, the major Wall Street banks, to fail immediately afterward.
Paul Volcker and the Treasury Department went into immediate emergency overdrive.
The fate of the entire system was hanging by a thread dependent on keeping Bash Group solvent.
They weren't trying to save Nelson Bunker Hunt. They were trying to contain a financial nuclear meltdown.
Precisely. They mobilized the country's top bankers, putting immense governmental pressure on them to act. The result was this unprecedented, desperate, last-minute containment effort.
A consortium of banks cobbled together an emergency $1.1 billion line of credit.
Extended to the Hunt brothers. But it was contingent upon them winding down their positions entirely and paying off their brokers.
So the bailout money didn't go into the Hunts' personal bank accounts. It went directly to paying off the brokerage firms and stabilizing the system.
It was a mandatory systemic rescue. If the Hunts had defaulted, Bosch would have collapsed, and that would have dragged down the banks.
So by giving the Hunts the money to pay their debts, the government essentially contained the damage.
They used the Hunts as a mechanism to prevent their default from destroying Wall Street overnight.
The public reaction to this must have been intense. I mean, given the public spectacle the Hunts had made.
Oh, it was furious. The sheer audacity of their attempt to corner the market, driving up prices for everything from photographic film to jewelry.
Yep.
It created massive public outrage.
And that sentiment was perfectly captured the day before Silver Thursday.
Yes, when Tiffany & Co. took out that famous full-page ad in the New York Times.
What did it say?
It publicly condemned the Hunts, saying, "We think it is unconscionable for anyone to hoard several billion, yes, $billion worth of silver, and thus drive the price up so high that others must pay artificially high prices for articles made of silver."
Wow, that ad just perfectly illustrates the tension, doesn't it? The Hunts were waging this ideological war against fiat money.
But the casualties were ordinary consumers and businesses.
Yeah.
The bailout contained the immediate flood, but the resulting investigation and regulatory reckoning were long, public, and brutal.
So the system survived, but the Hunts' empire was utterly destroyed by that regulatory counterpunch. What was the long-term public reckoning for the two architects of the Silver Corner?
Well, that $1.1 billion emergency loan was purely to pay off debts, not to save their fortune. Their finances were ruined.
And they faced mountains of civil lawsuits from angry investors who'd lost billions when the silver price collapsed.
Right. Their vast oil properties and other assets had to be liquidated just to satisfy creditors.
And the official legal action, that took years to materialize, didn't it?
It did. The key official action came in February 1985. That's when the Commodity Futures Trading Commission, the CFTC.
The primary regulator of U.S. futures and options markets.
They formally charged Nelson Bunker Hunt and William Herbert Hunt with manipulating the silver market. The charge was essentially that they had deliberately driven up the price and created an artificial shortage.
And the legal battles just drained the remaining energy and resources. It was a steep fall from their position as titans of global wealth.
Monumental. In September 1988, the two men who had once commanded a third of the world's silver supply were forced to file for personal bankruptcy.
So they were financially ruined. The system didn't let them take it down, but it didn't save them either.
Not personally, no. And the near-death experience of Silver Thursday led directly to permanent systemic fixes to make sure no one could ever repeat this maneuver.
So what was that long-term regulatory wall?
This is the true legacy of the crisis. The regulatory bodies, chastened by how close they came to failure, realized they couldn't rely on last-minute emergency rule changes like Rule 7 again.
They needed something permanent.
So the CFTC established strict, permanent position limits.
Explain what position limits mean for a modern speculator.
Well, they cap the total number of futures contracts in any single commodity that one person or group can hold, regardless of how wealthy they are.
So this regulatory wall was specifically designed to prevent any one entity from accumulating enough leverage and physical control to hold the global market hostage again.
It directly addresses the core mechanics of the Hunt's destructive strategy.
And the final official conclusion to the Hunt story came in 1989.
Yes. In December 1989, the brothers reached a final settlement with the CFTC. They agreed to pay significant fines, $10 million each, And most importantly,
They were banned for life from trading commodities.
that initial vote on Sulfur Rule 7 didn't just stop their trade. It set in motion a chain of legal and financial ruin that permanently exiled them from the markets they had tried so hard to conquer.
When we look back at the Silver Corner, the story can seem neat. The bad actors were neutralized, new firewalls were put up, and the system worked.
Right. The CFTC position limits appear to be the comforting final answer.
But that comfort is entirely based on hindsight.
Absolutely. The core insight here is that the system was saved not by its existing rules or its automated safeguards. For years, the Hunts used those very rules leverage and demanding physical delivery to push the market to the brink.
It was saved by a desperate, controversial, and emergency invention. Changing a single procedural rule in a private room made by a handful of fallible humans under unimaginable existential pressure.
Precisely. This multi-billion-dollar global crisis, which threatened to shatter the American financial system, it didn't hinge on an election, a presidential decree, or a global treaty.
It hinged on a handful of votes on January 7, 1980.
The Hunts had the will to push the system to the breaking point using its existing mechanics. The system was saved only because another group of humans had the will to push back by temporarily abandoning precedent.
And that reveals the essential fragility thesis, that the vast, complex, modern financial architecture ultimately rests on unpredictable, unquantifiable human judgment.
The system was saved because just enough people chose intervention over market purity.
That decision on January 7th was the definition of an invisible hinge, a moment that, from the outside, looks like simple regulatory procedure, but was, in fact, the fulcrum point of global history.
Today, markets are exponentially faster. Algorithms control trillions of dollars of trades, capital flows instantly across borders.
And the complexity is far beyond what the Hunts commanded in 1980.
The legacy of the Silver Corner is that chilling revelation. Our stability is not automatic. We build these complex financial machines, but the critical turning point in a crisis almost always comes down to human decision-making under stress.
We have position limits now, yes, but human ingenuity in exploiting loopholes is infinite.
It is.
Which raises an important question for you, the listener, to mull over. If a new crisis of comparable scale occurs today, if a sufficiently determined entity finds a new vulnerability in a derivative market or some interconnected financial sector, what will be the critical turning point?
We have automated systems designed to prevent collapse. But if those fail, what other invisible hinges is our world turning on right now? What group of people, in what unpublicized room, holds the terrifying power to change the rules in the middle of the game and avert catastrophe?
That moment of ultimate discretionary human judgment, it remains the true vulnerability of our financial world.
The ghost in the machine is still waiting for its moment to act.
That's a powerful and humbling thought to end on. Thank you for joining us for this deep dive into the 1980 silver crisis. We hope you feel thoroughly informed and a little more aware of the invisible hinges that hold our world together.